All right, well, we do have quite a bit to talk about today, and it's not all great news today, y'all. We've seen interest rates move over the last 5 days or so, and not in a good direction. So we're going to dive in and look at some of the reasons why. Let's start by looking at where the numbers are. Again, these are national averages according to the Mortgage News Daily website. Today, they have the national average for a 30-year fixed rate conforming loan, 6.44%, y'all. We were at 6.32% last week, 1 week ago today. In fact, we were at 6.32 for about 7 consecutive trading days leading up to Wednesday of this week when we saw a really serious sell-off in the bond market. We're going to talk a little bit more about what that looks like. We were at 6.45 30 days ago, so we are right now sitting right where we were 30 days ago, y'all. So the sky is not falling on interest rates, but again, those lower sixes that we were seeing, we're just creeping a little bit closer to the 6.5 mark where we are today. Not a huge difference in payment on a practical standpoint. Here's where we are with what's moving the market, y'all. We saw oil hit 120 bucks a barrel. That was a big psychological barrier for the market. That happened on Wednesday. That caused a bit of a sell-off in the bond market. You couple that with the news that Chairman Powell, Jerome Powell, plans on staying on as a Fed governor after his term expires from being the Fed chair. Of course, we know Kevin Warsh is taking that chairmanship over. The pathway has now been cleared for that by Tom Tillis in the Senate. So we will be seeing Warsh advance to the chairman's role. But the markets did not like at all, the bond markets rather, didn't like at all that Powell is going to be staying on as a Fed governor, because as a previous chair, he's going to have very likely outweighed influence on the remainder of the Fed governors in how they vote. In other words, Powell staying on is going to make Kevin Warsh's job quite a bit more challenging if he wanted to reverse course with the Fed and get into a more easing posture. We're less likely to see that now with Powell staying on, as he has the right to do. Very frustrating in that regard. We also got yesterday personal consumption expenditures. That is the Fed's favorite gauge of inflation. Two-edged sword on this report, y'all. It came in as expected. However, it was expected to come in quite high, and it did. It came in 0.7% month over month. It was year over year, we went from 2.8% to 3.5%. And again, nearly all of that jump is related to energy cost, y'all. So this is the first real PCE report that we've had since the Iran war has pushed prices of gasoline so much higher. So now we're starting to see reflected in the inflation numbers the cost of gasoline. Now, again, this isn't inflation that is being driven by a seller's ability to increase pricing due to an overheating economy, y'all. Though that specific is what the Fed is able to moderate against with restrictive policy. This is a simple supply-related issue that the Fed really is powerless to do anything about. So it's unlikely that the Fed is going to view this as continuing inflation that they need to moderate, especially Kevin Warsh, y'all. He won't read it that way. This will more likely be viewed as temporary. However, the possibility of cuts is essentially off the table until this resolves. So we need to see gas prices come down before you see the Fed become more accommodative in their posture. To that end, the CME FedWatch tool, you have to go now to October of 2027 to find an instance where the odds are 50% or greater of a cut of 1/4 of a point or more. That's quite a bit down the road, y'all. That is a year and 6 months. That's 18 months from now before we have even a 50% chance of a cut by the Fed, according to Fed futures. In fact, we have a 15% chance of a 1/4 point hike leading into the January 2027 meeting, y'all. So at the end of this year, the markets are more inclined to see a hike than they are to see a cut. I don't think we're going to get a hike, y'all, but I do think the odds of us seeing a more accommodative Fed are pretty much off the table until we see a resolution to this war and we see the oil flowing easily again. That's just where we are. I guess the good news is we haven't seen much more volatility in interest rates. We are still staying in the mid to low sixes. As long as we stay there, y'all, we're not destroying the marketplace, and I'm still quite busy with new purchase business, and I appreciate all of you for that. In any event, that is the weekly update for May 1st, this Friday. I hope everyone is staying safe. We had a lot of flooding in my area today, and I know that's causing a lot of concern for a number of folks. So please stay safe, stay blessed. We'll talk to you next week.